Thinking about refinancing your home or investment loan? Finny Mortgages makes it easy. Our team of expert brokers handle all the hard work, finding you the right loan at a better rate. Book a free no-obligation call today and see how easy refinancing can be. Visit finny.com.au or call us at 02 8866 2444 to speak with an expert. This is a Momentum Media production.
Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, g'day everyone, it's Liam Garman here, editor of Smart Property Investment, back today with another episode of the Smart Property Investment Show. And I'm joined by two gentlemen who need no introduction because we were only chatting a few months ago now. It's, of course, Simon Buckingham and Brendan Kelly, directors at Results Mentoring. Gentlemen, welcome back to the podcast.
Thanks for having us, Liam. It's a pleasure to be here.
Likewise, Liam.
And I can't believe it. So when we were chatting before this, and I went back online, and I can't believe it was 7 November since our last podcast. And by the way, it was a real fantastic podcast. For people that are listening, do go back, listen to the previous podcast as well if you want the formula for financial freedom. We were unpacking that education side and about how investors can stay educated on market movements. The hot suburbs as well. We were talking about those boom suburbs. So something that a lot of our listenership would love to hear. We'll put a link for that in the show notes as well. But we do have a bumper podcast today as well, unpacking some new announcements in Results Mentoring and as well as some market overview. Brendan, Simon, since we last spoke 6-7 months ago, what's news in the world of Results Mentoring? You guys have announced a fair few new things.
Oh, we've had a couple of things occur. The big one that I think Simon's really well positioned to speak on is the new app. We have gone public broadly, widely with a new property investors app called Real Estate Success Community.
Yeah.
We believe wholeheartedly that it has the capacity, if not the destiny, to be the epicenter of all communication for property investors around what's happening in the market, around how to meet and greet others, network. Yeah, very excited. Simon.
Yeah, so the Real Estate Success Community is a new free but private network for property investors, particularly those who are seeking financial freedom or simply financial security. But it's designed to help people make smarter property investment decisions that will ultimately change their lives for the better. And it's built around providing expert updates on the latest property market trends. So Brendan and I are constantly in the community, keeping people up to date. There are inspiring case studies of real life property deals as well. So we'll often interview people about property investment deals that they've done or renovations or developments that they've done recently, how they put those together, what the outcomes were. So people can take those tips and tactics and strategies and apply them in their own investing. But really importantly, and the emphasis here is on community, it's a private space where active property investors can come together and ask questions of each other, share their wins, but get those important learnings and contacts so that they also avoid costly mistakes in their investing. So it's a really powerful platform. It is free to join. People can find out about it at realestatesuccess.community on the web, or they could just search Real Estate Success on the App Store or Google Play and actually get the mobile app, which is also free to get access to that. So it's a really exciting thing to be part of and to be building, and just to see how it's already taking off and people are really engaging with it. It's brilliant stuff.
That's fantastic. And Brendan, you used the word destiny before, which is strong. It's ambitious. But Simon, when you're going on that journey, I'm a pretty visual learner. So I download the app. What's the layout? What's the process? Because ultimately this is about learning from people that have made it. This is learning their mistakes, their wins. One thing that I find in the world of property investing, especially if you're, say, a new and upcoming property investor, and I speak about this a lot, where we have a lot of listeners to this show that might become accidental property investors. They've got a property through inheritance, and now they're trying to chart their own course here, all the way through to people that have been investing for years and years and years. People want a silver bullet, but really those silver bullets are from learnings and lessons that people have had in the past. So the opportunity to learn from one another is critically important. Take us through that visual journey. What does the app look like? What can it do? How do you engage with other people? How do you even engage with people that are on the similar journey as you?
Yeah.
Firstly, that's a big question.
I'm known for long-winded questions.
But let me have a crack at it anyway. So we often say that property investing is much more about people than it is about bricks and mortar. And that's where having those connections with like-minded property investors, people who are on a similar journey to yourself, who are doing the kinds of things that you want to do. Having those connections is so important to your own success. And we've certainly found that in our own investing journeys over the years. And it's a big part of why we've built the real estate success community now. But it's really easy to get on. You jump on, you create a profile for yourself. It's an AI-driven platform. So the AI will actually help you build your own profile so that you can put yourself out there to connect with people who are like you. It's not quite a dating app for property investors, but it does use the artificial intelligence to identify similarities so that you can more easily connect with people that you want to connect with in the property investing space, which is really, really exciting stuff. And then there are a number of spaces within the community platform where you can go and find out about upcoming events, live streams that we're doing, or physical meetups around the country that are happening where you can meet and connect with other investors. All of that's there, and you can connect to those and RSVP for those. You can get access to recordings of live streams and events as well. All of that's there. And there's a stack of educational resources, whether you're just getting started or are some way down your investing journey or even quite advanced. There are all these educational resources that you can tap into there, videos that you can watch, discussions that you can get involved in with other investors and so on. So really exciting stuff, real next generation stuff. There's nothing quite like this out there. Really in Australia at all. So very exciting to be part of it ourselves, and would really encourage other people to check it out. Like I say, it's free. There's no hidden sell or anything like that. So jump in, be part of the community, start making those valuable connections and see the difference that it actually makes to your investing.
Now, over the last 2 decades, you both have been very involved in property investing. Could you give us a little bit of a snapshot of your journey to date and also with results? Because I think there's going to be a lot of people who are listening to this like, sounds fantastic. Well, what about Brendan and Simon? What's their background in investing?
Yeah, sure. So, I mean, we've both been investing for decades now. It makes us sound very old. And the grey hairs are perhaps showing through. But I went from working in a corporate job that, frankly, I hated, just feeling the stress and the pressure and the rat race, as they call it, that endless spinning wheel, to getting out of that environment in the short space of about 3.5 years after I made the conscious decision to actually start taking action and educated myself in different strategies to what most people were using. So in the short space of 3.5 years, I was able to transact on over 30 properties, which most people don't do. And that's because most people invest in a certain way that gets a certain outcome. They don't understand there are different ways to go about it and different ways to understand the market. And hopefully during the podcast today, we'll talk a little bit about what's coming in the market and give people a bit of a leg up to be able to take advantage of that. But for me, that was really exciting to see that the possibility that existed that was very different to the typical get a job, get promoted through a career, ultimately retire in your 60s or 70s, to see there was a different way of doing things. And so by utilizing strategies ranging from positive cash flow through innovations, developments, commercial properties, investing here, investing in New Zealand, over the years, gone through all of those sorts of strategies ourselves, learned from them. And that has given us the ability to then impart some of what we've learned to other people. So one of the other things that's really exciting is that we've just been able to celebrate our 20-year anniversary, haven't we, Brendan, as Results Mentoring. So we've been coaching, mentoring property investors through results for 2 decades. And we've seen hundreds and hundreds of people through our program, many of whom are now financially independent as a result of the support we've been able to give them, which is really above and beyond what we've done with our own investing. It's really fulfilling to be able to see other people be able to take advantage of that and make such a big difference in their lives. So, yeah, so whether it's been through our own journey, our own investing, or actually supporting others through theirs, it's been a very fulfilling couple of decades, I've got to say, the last 20 years.
Huge.
Now, I know last time that we were speaking in terms of that financial freedom, you both were very, very ambitious with people that you work with in particular. I think the example was at Brendan, I think you gave about sipping Aperol spritzes in Italy or sipping wine in Greece, but giving people the financial ability to do that if they so wish. We spoke about just then, Simon, you said you did 30 transactions over the course of a few years, which realistically, even for a lot of people that listen to this podcast, that might be a lifetime plus more of transactions done in a few years. To the both of you, I guess, what's the special sauce? Because I know that so many people get stuck, number 3, 4, they don't know where to go. They might be, maybe a bit too passive with it, or they might get sidetracked when they're making their strategy. What's the special sauce to get to that level?
Yes. So, we could tell you, but then we'd have to kill you. But no, it's, I think one of the things to realize is there's no sort of get rich quick solution or silver bullet in property investing, but there are smarter ways to go about it. And there are more sustainable strategies, more repeatable strategies, and less repeatable strategies. Most people invest in a particular way, which is typically I'm going to go and buy a house, usually negatively geared. I'm going to hang on to it for growth over the long term. I'm going to, what's the phrase, Brendan? Hope and pray that it goes up in value enough to give me what I want by the end. But they go into those deals with no education behind them, no real strategy, and really a lack of understanding of why they're doing it, their financial goal. So a question I'll often pose to people is, well, if you think about the properties that you have got or that you're considering buying, do you know how much that property has to make for you in dollar terms and by when, to know that it's contributed to your financial goal, if you've even got a financial goal? And it's really starting with that end goal in mind, understanding why you're doing this in the first place financially, what is it you want to get out of it and by when, and working backwards from that to go, okay, well, what strategies, what types of properties are actually going to help deliver on that? And being open-minded enough to accept that there are different ways of doing things that are going to help you achieve that. And then you become educated in those strategies, you apply those strategies, but they have to be sustainable, repeatable, and scalable strategies so that you can actually go from one deal to the next and keep scaling up and not keep running into the borrowing capacity issues or running out of capital. Brendan.
You're after the secret sauce. The secret sauce is actually the education, the understanding of self, the education of self. And in the understanding of self, the what is it you want to get out of it? You say people start out accidentally. They get a house that's inherited, or they happen to go, oh, somebody told me once upon a time that property investing was a good thing. Ready, fire, aim. Let's go and buy one. Now figure out what we're going to do with it. Now, from the model of that's I'd call it uneducated or lesser educated position to start from. And if you approach the rest of your life from the perspective of that's how I did it the first time, that's how it works, it's going to stay that way, then you set yourself up for a more difficult path. You put yourself out there to learn, to listen to different ideas, as Simon said, listen to different models and different ways of thinking. Start to introspectively consider what it is that you want to achieve and by when you want to achieve it. You then forcibly open the door into different ways of thinking about playing the game. There are, as you say, a plethora of ways of doing this. And yes, the vast majority do the buy, hold, wait till there's enough growth, draw down, go again, wait till there's enough growth, draw down, go again, hope and pray there's a few promotions in the meantime that I can earn more money, increase my borrowing capacity. With the drawing down will give me the capital, the borrowing capacity will give me the ability to buy more, and maybe in 30 years I'll be able to buy 2 in the same year. That sort of model. And that's actually a very solid operational model if you're starting at 20. But most people wake up at 40 and go, hang on a minute, I don't think super's going to do it. And if they then fall into it, there's a certain limitation. There's a support that can be applied to the superannuation model that they've adopted out of their lives through holding property and over time. It's not necessarily the most efficient way to earn great cash flow in their retirement, but it'll supplement what they're doing out of their lifestyle and their 40-year plan of working forever. But there are ways that you can get out in 5 years. There are ways that you can get out in 7, 10 years comfortably. And it's well, hang on a minute. I've not experienced that, or I've not seen that, or I don't know it. In which case, then there's the invitation. If it exists, just open the mind to start the conversation with somebody about it and see where that leads, because that opens the door then to a whole new way of thinking and a whole world of strategic approaches you otherwise won't know exist yet. So you want the source, get into the education, get into the asking yourself of questions, get into self-exploration of what it is you want to achieve and by when. And out of that, what is it? The necessity is the mother of all invention.
Innovation.
Yeah. Once you come across I need to get out, or I need to achieve this, or I want this in my life, then the doors start to open up as you explore models of achieving.
I love podcasting with the both of you because I find I'm just nodding most of the time. It reflects everything that I see day to day in the world of investing. Brendan, I love your point where you kind of throw the dart at the dartboard and then it's the afterthought of, well, you're going to factor in the promotions in the future and then maybe you might be able to scale. And really, actually, the wage data doesn't really reflect that. You're right, at 20 where you've got that growth. But once you're, not everyone's going to be a CEO, right? So there's going to come a point where, the wage growth might plateau a little bit. And on that point, I see so many areas where you're at the barbecue and people are like, no, you just got to get your foot on the ladder. You got to get your foot on the ladder. There are so many areas that I'm looking at in Sydney where I feel like when I go on CoreLogic now and I look at sales data, I'm looking at the same sales I saw a few years ago. There doesn't seem to be much more than a 5% growth. So if you're taking this, I think Simon used the term less educated, that beginner approach where you're just throwing a dart at the dartboard just to get on the ladder, you might actually be hindering yourself in the long run.
Absolutely.
So starting off with that education is critically important. Gentlemen, millennials, Gen Z. Now, I know this is a little bit off topic, but just the way that you communicate to people, the way that the advice that you would share with them, is the advice that you would share to younger Australians different to people that, Brendan, waking up at 40? And how would it differ given market conditions?
So you're saying old head, young shoulders. What can you do about that?
Oh, well, I mean, in the sense of the property market's evolving. For people that really are brand new on their journey that are coming up now, is the strategy different or is the strategy really, really the same?
Yeah, great question. There's a lot of it that is this. See it, and you're going into multiple perspective positions. So if you go into the fundamental, the most common perspective, which is buy, hold, never sell, hope and pray it goes up, hope and pray I get enough promotion. Yeah. Does that still work? Actually, yes, it does. Yeah. The lowest median suburb value in this country is $40,000. You can go and buy a house for $40,000 somewhere. Yeah. Happens to be the middle of South Australia near Coober Pedy. Now, if you went out and did that, sure, you're in. Yeah. Would you expect much growth? No. If it's taken 100 years to get to $40,000, no, you're not expecting much growth. But you're looking for a good positive cash flow outcome. Yeah. So you start to generate a revenue, and that supports you then in potentially buying something else somewhere. That's possible. Do we recommend that? Not necessarily. Can you start out small and cheap? Absolutely. You can buy $100, $150, $300, $200,000 apartments with growth potential. Yeah. And then in lies the whole hope, pray, never sell. If you're young enough, because you are talking millennials, you are talking Gen Zs, if you're young enough and if they want to get into that. But if you've got a Gen Z that says, and I've got a millennial or two, in fact, that I know very, very well, they're my kids, and they're out, I don't want to work. Are you serious? Working's for you boomers. I don't want to work. There's so many different ways to make money now that's not working. That's what I want to do. And I'm going, yep, sure. Banks are going to love you. And then, so there's a whole ethos now as Gen Zs and millennials wake up into, actually, there is a certain grind to earning money and a work ethic I'm going to have to adopt and grow into. Sure. So there's a waking up of that. You've got a lot of millennials having kids right now going, mouths, responsibility. I don't know what that is. So a bit facetious on my part because, I'm still an ex-boomer type guy, but turn that around. The point is simply that, yes, the same path can exist, but is that going to be the most effective path for them? Is that going to give them what they need? And what are the choices out there now? There is so much more tech, so much more information, so much more stuff available to support them with their property investing journey that we didn't have. Not like we're crying poor or foul, but we didn't have that. Therefore, it can change the nature of the game. That said, the fundamentals still remain. Requires energy, requires effort, requires knowledge, requires skill, requires an evolution over time, and it requires growing into it. Off you go.
I think on that note, so the fundamentals remain the same, but the information, the education that you have on your fingertips, at your fingertips, it simply didn't exist a few decades ago. I mean, in this, I don't know how long this podcast is going to go for, but let's say it goes for 50 minutes. In this 50-minute podcast, this is reams and reams and reams of literature, of learnings, of knowledge that has gone into this discussion. And then if you go and, you get the app and you talk about it with people afterwards, you are rapidly onboarding information that took people decades and decades and decades to figure out. We are sitting at the cusp of quite, in my opinion, quite a big market shift at the moment. We have a plethora of new demand side policies coming through, in particular with the first home buyers guarantees and schemes. Simon, Brendan, what do you make of the market in the next 6 to 12 months?
Yeah, there's a lot of change happening at the moment. We're already seeing an acceleration in growth in a lot of the country just off the back of interest rate cuts that we've had so far this year. And by the time this podcast airs, we may have had another rate cut as well. So that's driving borrowing costs down, borrowing capacity up, which is obviously demand stimulating. And we're already starting to see that reflected in some of the statistics around the property market and the way that values are growing. But that really pales in comparison to what's coming early next year. So one of the things that happened leading into the election was that Labor dropped a sort of a last minute election promise or new policy designed around housing affordability, but particularly with respect to first home buyers, where they announced what's called the Universal First Home Buyer 5% Deposit Guarantee Scheme. Now, that whilst there have been deposit guarantee schemes in existence, they've been for limited numbers of people. They've been fairly tight on price caps, and they've been a little bit restricted. What we're talking about here is a really big change, probably in the order of magnitude of the introduction of the original first homeowners grant, which did have quite a stimulating effect on the market. And there have been studies done on the first homeowner grants that happened since 2000 onwards that suggested that each time something like that was introduced, it translated to something like a $50,000 increase in property prices. So what we've got happening now with this first home guarantee scheme is that it's not going to be means tested. So it will, if I just run through some of the key features of it very quickly, it's for all first home buyers wanting to buy their first home. The objective is to enable them to do that with only a 5% deposit. The government effectively guarantees 15% of a 95% LVR loan. So that has the effect of meaning that if the first home buyer wants to borrow 95% towards the purchase price, they don't pay lenders mortgage insurance. And that could save them tens of thousands of dollars right there. There is no income cap on this. So it doesn't matter what an individual or a couple is earning. If they're first home buyers, they qualify for this. There's no limit on the number of places, and that's really important. So this effectively is every first home buyer who wants to take advantage of it. Really interesting here as well is that this applies to both new and established homes. So any property that fits within the property price limits that this applies to is potentially up for grabs under this scheme. And they've introduced some higher property price limits, which are based on location, but they're really generous. So it ranges from as high as $1.5 million as the price cap in Sydney and Newcastle, down to, I think, Hobart and Darwin have $700,000 and $600,000 limits respectively. And there are slightly lower limits in the regions.
The model around that, as I've read it, as in retrospectively looked for it, is that they looked at the median prices in the suburbs, in the cities for houses, and the median prices in the cities for units. And they've said, well, based on that, we want another 10 or 20%, typically 10% above that median at the time of creating this file. So they've allowed them, so basically 60% of all dwellings right across the country are available to be purchased by first home buyers with this scheme. That's 60% of all dwellings. Now, that is a phenomenal volume of houses in this country that first home buyers can get into. And therein lies the basis of the impact this has the capacity to apply to.
Yeah. And this is not a replacement for, but is actually on top of any existing first home buyer grants or duty concessions that any one of the states have,
Correct.
which can be at different thresholds to where this kicks in. But there's the possibility that you get a combination of being able to get in with just a 5% deposit, but you also get a stamp duty concession if you're under the right threshold for that. Or you might even get a grant as well. Like if you're buying a new place, you might be able to qualify for some sort of first home buyer grant to even reduce what you're putting in even further. So that the practical impact of this, if we take a couple of examples, if I was a first home buyer in New South Wales, I could potentially purchase, say, an $800,000 home on this scheme with just a 5% deposit or just 40K with no lender's mortgage insurance and not pay stamp duty due to the current first home buyer concessions there. So as long as I can qualify to service the 95% loan, I only need $40,000 and nothing more to buy an $800,000 home in and around Sydney or Newcastle, for example, or anywhere in New South Wales for that matter, because even the regional threshold is $900,000 there. So that's phenomenal in terms of the number of first home buyers who can now access the market. In Queensland, they've just introduced some additional concessions and equity sharing schemes and so on as well. But ignoring the equity sharing side of things, in Queensland, due to the first home buyer grants, which are $30,000 and duty concessions, a first home buyer could theoretically buy a brand new $600,000 home with $0 down because the first home grant of $30,000 would be the 5%. So this is due to be implemented from the 1st of January next year, 2026, if all goes according to plan. The government has left itself a little door escape clause here where they've said, following consultation with industry, but this is a pretty major election promise to go back on. So
I don't see them walking this one back.
No, it'd be very difficult for them to do that. I agree.
I do agree, Simon, with this sense of urgency. I think is a reasonable way of putting it, because when I look back to when I bought my first property and the differences between this and what we had even then, my wife and I, we didn't even bother with the first home buyers grant or the stamp duty concessions, because at that point in Sydney, it was up to like $600,000. It was like, and it had to be a new build as well. And you're at a point where you actually lock out such a big part of the city where it's like, well, what's the point? You know, reasonably, you're somewhere where you are not near family, not near friends, not near where you work. What's the difference? Well, I've got to drive to work, $50 in tolls every day. Like there are reasons why a lot of people would forego it. This removes quite literally all of those barriers where you can go for established homes. So you're not limited there. You don't have anywhere near as the caps on how expensive the property can be. This will not just have capital flow into the new builds on the outer rims. This is going to go right across the swathe of asset classes. And I think a lot of people might be seeing this and then, you know, they'll be bidding up themselves. So I see this impacting, swathes and swathes and swathes of asset classes.
Yeah, absolutely. I mean, as Brendan said, this is essentially 60% of the market that this could potentially affect. And, you know, when you combine this with falling interest rates, a rising borrowing capacity over the coming months as well, and the additional incentives that the various states are putting in place for first home buyers or already have in place for first home buyers, you can see that this stands to have a really, really significant impact on the property market. So if you are bringing forward a whole lot of first home buyer demand that otherwise would have been spread out over months or even years as people saved up deposits that they no longer have to save up for, so they can bring forward their buying decision. You'll probably also see a little bit of a lull at the back end of this year as first home buyers put off.
Can I go through a little bit of the forecasting around?
Yeah, so let's talk about what this is going to do to the market and where we see the market going.
At a macro level, if 60% of the population or 60% of the dwellings can be bought, means that 40% won't be. So it's only the top 40, 35, 40%, let's say 35% of suburbs won't necessarily be directly affected by this. So the implication is then the lower echelon, the lower 25, middle 50% are likely to be the most affected suburbs. So that's where you're going to see the most growth. If it works out then that there is growth, and we're talking next year, not necessarily this year, we'll talk about that in a minute, but if that works out that most of the aggression towards buying occurs in those suburbs, you're going to find an inspiration from those owners in those values who are more cashed up, more borrowing capacity, more established, go, you know what, now is the time I need to sell because I want to upgrade. And if it is that the more expensive suburbs are not getting this same level of growth or burn rate for urgency, then you'll see people moving from this hot pocket of values into cooler but more expensive pockets, and therefore drive price up in the more expensive suburbs over time. There'll be a ripple effect that you'll see coming forward in that. So if you've got something that's your own home, or you've got something that is a rental that you've had for a long time and you're a long-time seasoned investor, let's say, and you're in their more expensive suburbs, don't despair. That growth will come for you, let's say, later 26. Yeah.
It'll filter up.
Yeah, correct. It does. Yeah. It would have to, correct. And it's also an incentive for downsizers to go, you know what, I'm out now. There's enough money in this. There's enough in this. I got enough of a prize now for me to exit and go to the country or do my seed change or tree change. And you'll start to see an increase in the volume of listings and activity in transactions, which has the capacity to support more first home buyers getting into the market, et cetera, which is good. Marginal pressure variation. There's still significantly limited stock around the country. All right. Let's talk leading into January, though. Given that this is a first home buyer's grant that comes effect on January 1, you're going to get people going, I have to move. It's just, I can't deal with my parents anymore. I can't deal with this rental scenario anymore. I've got to get out. And first home buyers with 6 months to wait will say, stuff it, I'm going and I'm going to get it. And they'll just do their best they can with what they've got. Closer to January 1, 26, you're going to see people hold off. So you're going to see a plateauing in that burn rate in those lower value, the lower 60% of property prices, because people have to move, but there's not going to be as much activity. And a lot of people will hold off on their sales. So you'll see listings diminish because they're not going to list them. You'll see buyers diminish because they're not going to buy them. Median prices are just going to meander along leading into that point, probably flatten out a bit. But then come first quarter, second quarter 26 is when you'll see the significant lift. And it'll kind of start on January 2nd if real estate agents are open. You know, people will be eyeing the market during December and November, going, that's one I want, that's one I want. Don't sell it. January 2, here's my offer. Yeah. And take advantage of that. So there'll be a lift early January, spike early January, leading into first quarter. Okay.
So what will this mean for investors? Because, and look, a lot of this comes down to where you are on your growth cycle, what you're looking to achieve. And there are going to be people out there. This is actually, and I don't want to speak for the experts, fantastic if you're going through that consolidation phase, because now the price of your assets going up, you clear off the debt, you might have a lot more money than you reasonably expected. For investors at the beginning of their journey, putting myself in these shoes when you're in that accumulation phase, what does it mean for investors at both ends of the spectrum?
All right. So for those who are looking to reduce the volume of stock that they've got, what did you call it? What was the word you used?
Consolidating.
Consolidate. For those who wish to consolidate, don't do it now. Seriously, don't do it now. If you've got cash flow issues because of high interest rates, suck it up a little bit longer, but play the game towards the back end of 26, because that's when most of the prices right across the country will have lifted, and that's the prize time, maybe leading into 27. But I would be encouraging back into 26. For those who are just starting out, I'm about to get my first or my second, or I'm in a growth phase, or I'm in an accumulation phase. If you have the money now, I would be encouraging you during winter to buy something, or I'd be encouraging during the flat spot, late November, December, to buy something, because it's not your first. You're not going to be able to take advantage of the first home buyers thingy. Too many words. I can't remember what it's called, but it's first home buyers thingy. You can't take advantage of that. But what you can take advantage of is the calm before the storm. You can take advantage of the flatter period, knowing full well that the prices will climb post that period. So I would be encouraging you to get your loan approval sorted in the next couple of months, if not immediately. Get your cash sorted, start your joint venture conversations of playing with somebody else, and then start to accumulate.
Yeah.
Now, that's from a buy and hold perspective. But from an active perspective, if you're looking to do renos, cosmetic renos, if you're looking to do subdivisions, if you're looking to do developments, frankly, the same rules kind of apply. Pull that together now, buy now, and then you will get a capital growth lift to support profitability of your project on into 26.
Yeah.
I say, though, I'm not a real fan, and I'm going to put it out there, I'm not a real fan of buying 40-story apartment blocks today for something that's going to be finished in 29, 30, and 32. I'd be going, there is far more profit to be made in shorter, faster turnover projects completing 26, maybe early 27, than there is in the long-held ride for forever growth period to make an absolute packet in 6 years' time when I finally sell it. I'd probably encourage not doing that.
Yeah, I'd echo that. This is not a land banking set of market conditions.
Correct.
This is about a window of opportunity that you have to capture a wave of growth into 2026. But realistically, you've got about a 6, maybe 9 at most month window to do something. So we come back to your point, Liam, about having that sense of urgency. I think it's really critical if you do want to make a difference to your personal wealth, is that you've got to capture some sort of sense of personal urgency with what you do. Otherwise, you procrastinate, put things off. You look back in 2 or 3 years and go, I wish I had. There are a set of market conditions staring all of us in the face right now that if we don't act on it in the next 6 months or so, you will look back and go, gee, I wish I'd done something. So whether it's I'm going to go out as a first investor and buy my first place, and you could even do something like, if you are a first home buyer looking to get a leg up on the property ladder, this is a perfect opportunity to get in with reduced capital and get some market-driven capital growth by picking the right property in the right area, or by doing something like, say, a live-in reno, Brendan, where you actually get in there, improve the property over 6 or 12 months, and then look to realize your gain at the back end of that and go again with more working capital. It's a perfect opportunity for that sort of first time starting out buyer investor to take advantage of.
That strategy is my favorite to get started. It is something that if you're willing to do, live in the chaos for a while, if you're willing to do that, that is going to be the greatest way for you to build equity rapidly, and particularly in this environment. Buy, live in, add value by way of renovation, sell. Yeah. If you can do that, sacrifice your lifestyle. You're not having too many dinner parties. You're not bringing big party and friends' homes. You're living amongst the circular saws. If you can manage your lifestyle through that period, that will serve you well for the greatest potential equity lift to get started as a first home buyer. If you're rent vesting, now I'm not, Simon, the rent vestors, they've sacrificed already their first home grants.
No, not necessarily. So you obviously, all the rules are slightly different from one state to the next. So what you need to do is check the rules in your state. But you could potentially buy a property or if you already have one as a rent vestor, if you've never owned your own home to live in, you might still be able to qualify for the first home incentives in the state.
So for a rent vestor who's looking to get started, perhaps, and again, make sure you know the rules. Don't try and hope and pray that it's going to work and just shoot from the hip and pray that it does come off that way. You might be disappointed. Do the research first. But if you are a rent vestor and you're able to, my encouragement would be wholeheartedly, get in now, buy, add value, sell, I would be what we haven't mentioned yet is the potential interest rate drops that are coming too. If there are 2 more coming this year, you will see the investors back into the market for which the first homeowners thing doesn't work. It doesn't make any difference to them. And you'll see an increased level of interest in property markets. So getting in now before the next rate, admittedly, you've got 5 days before the next one potentially.
Well, by the time people are listening to this, it would have come and gone, Brendan.
Potentially, yeah. But the sooner you act on getting in, the better to the end then for riding the growth that's going to occur in 26. And then you would sell probably springtime 26 as a model. And you've got a year. And it's a lovely, lovely scenario of making equity really quickly.
Yeah. So if you're an experienced investor, so let's say you've already got a portfolio or you've done a few deals or you are already an active investor as well, what does this mean for you? Well, obviously, if you are not a first home buyer yourself, you can't take advantage of the lower deposit to get into a property or any of the other first home buyer incentives. But what you should be looking at is what is this going to do to the markets where I want to operate? Or rather, how does it affect the markets that I should be operating in and the products I should be investing in or producing through my active investing over the coming months? And again, that same concept applies, as Brendan said, you've got this 6-month window of opportunity right now to get into the market before those market segments start to really take off because of the additional demand that will pour into them. If you can cherry pick and secure good deals now, you stand to make that extra gain, that extra uplift as the demand pours in. But you would be wanting to make sure that your product is one that wouldn't necessarily exclusively appeal to first home buyers, but would appeal to first home buyers, that would sit under these thresholds so it will actually get the benefits. There's no point in me going and buying a $1.49 million property in Sydney thinking it's under the threshold. That's great. I'll get the growth, because the moment the growth happens, it's over the threshold and that demand drops away. So I need to be, a good 10, 20% under those thresholds in what I'm buying or in what I would otherwise be selling back into the market at today's values in order to see the benefit of that uplift.
And therein lies the smarts. Therein lies the requirement to do a little thinking. This is not a shoot from the hip model. This is a contemplated, smart approach to taking advantage of what is structurally being put in place. One last thought on this. Our experience, as much as it looks great from a macro level, as much as it looks great from a city-based level, not all suburbs go up at the same rate at the same time. You can go and buy in a suburb that just doesn't have the level of attraction that other suburbs might, and therefore you take a bit of a hit, or you don't get the money you otherwise could. And therein lies one of the dilemmas. So what you want to do is be able to read the market, look at the dynamics of the actual suburb that you're into, understand it. Now, there is a wealth of information out there to support you doing that. There's webinars, training, education. The app we've got gives us a pile of information on how to do that. There are ways to figure that out. But to support that, we've actually got a report that we want to give you. Liam, are you open for that?
Oh, I'm up for that.
This report, we've done some work in the background. We've got Australia's next hot boom suburbs, 10 of our latest predictions for which ones are going to grow irrespective of the changes that are occurring in interest rates and the first homeowners grant. And those 10 have the capacity as booming suburbs in their own right to be able to amplify the growth.
Now they've got to go online to get that.
Sorry, now an important point here is that we're not talking about suburbs that are already booming, are we, Brendan?
No, correct.
Because often people will say, often people will say, like, here's a list of boom suburbs, and what they mean are these are suburbs that have boomed, which is completely useless to you as an investor because you're already too late. This is stuff that our research is showing have the strong potential to outperform the market over the coming months.
No, that's fantastic. How can they get the report?
So to get the report, really easy. If you just head over to our website, resultsmentoring.com/boom, you can register to receive the free report there, and we will send that to you in a link via an email. So resultsmentoring.com/boom. Also, though, when you do register, you'll have the opportunity, if you wish to have a free strategy review with one of our team. where we can sit down virtually with you over the phone or Zoom and have a look at what you've already got in the way of properties and give you some insights into whether the suburbs that those properties are in are likely to rise or fall over the coming months as well. Give you some expert analysis on your existing portfolio and help you strategize some next steps, all completely free, just our gift to the listeners today.
That's fantastic. And I think with such a moving market, with such changing conditions, it's important to partner with experts. I know I always partner with experts because, you got a full-time job. You can't be expected to know everything yourself. So always leaning on people where you can. Now, I'm going to ask one final question, throwing it open to the floor. Brendan, you mentioned before that not every suburb's the same. Not every city's the same. People are always speculating about which city's next. Could you give a little bit of a snapshot into Australia's 5 major capital cities and what we expect for the next 12 months?
So rapidly, Perth is currently hot right now. It did flatten out for a while, but it's lifted on the back of the first interest rate drop in February. It's growing at a rate of 12% per annum at the moment. Yeah, that's the rate of growth right now. It's a booming city, aggregated. So there's a lot of growth. And the strong growth is going to continue into 26 on the back of what we've talked about. As a warning, though, as an alarm, given the global uncertainty around minerals, etc., I'd be nervous about overextending yourself in mining towns. Great cash flows on the back of the recent activity in mining, but just be nervous about overextending in that because it could change on the drop of a hat. Care required. Raise that alarm. Adelaide, the market cooled late 24. But started to pick up strong again from March this year. So we've seen good growth since March. Running at a rate of about 11%, another booming city at the moment. And the strong growth is is projected to continue for a little while yet. And again, on into late 26. Interest rate drops and the first homeowners thing is going to support the continued lift of price, even though Adelaide prices have got to a point where they're becoming unaffordable. The interest rate drops will make them affordable again. First homeowners grant will make it more cash ready again. So that will serve a revitalised lift into the Adelaide market. Brisbane is strong, has been strong for a while, staying strong. Price growth lifted again after March 1st, an interest rate drop. It's growing at around about 12%. Also, another booming city, growing about 12% growth and plan to continue again for the same reasons as for Adelaide on into late 26. Be mindful, though, there's a scenario that's occurring in Queensland, which is an increase in defence spending. Out there, Townsville Way, far north Queensland, the defence is ploughing money in there. That is throwing interest and house price growth, population growth. So monitor that. There's a lot of buyers agents who say, go up there, and that's been happening for a while. The growth is not over up there yet, but monitor it. Yeah, it's not too late to get in, but again, monitor it. Sydney's the surprise. Sydney is booming at 12.5% right now. Sydney is the hottest city in the country at the moment.
Wow. I take back what I said before when I was I must be refreshing it too much. Must have like immediacy bias when I'm refreshing CoreLogic.
Yeah, and it's getting stronger. So, and it will get stronger this year with the interest rate drops and with the first homeowner sting next year. All right. Melbourne. A lot of people are talking right now about Melbourne as, that's got to grow. It's so cheap. It's the best place. Houses are affordable. It's the best place to go. Well, the local government screwed that up entirely. So it's still not the best place to go. The taxes, the costs, the consequences, the big bill that's going on and the infrastructure changes, the difficult to get around. It's not the best place to be. And it's not the time for Melbourne to go from 4th position in the rank back up to 2nd. It's not going to jump that now. That won't happen now. A lot of people saying it's the next one, it'll take off and it'll go immediately. And this is the trigger for it. It's not the trigger for it. But that doesn't mean there won't be growth. Just like everywhere, there will be growth on the back of cheaper money, growth on the back of higher demand from first home buyers. So you will see the lift. That, for want of a better word, correction back to the 2nd position in the market, even potentially one that exceeds Sydney for the first time, That's coming, but we're not at that point yet. So don't buy here looking for that immediate doubling in price over the next 12, 24 months, because it's not going to happen. But you will get lift.
Yeah.
And yes, it is more affordable, and there is a lot of interest in Melbourne for the perspective of being more affordable for a capital city that will eventually settle. So if you're looking for a long-term win, then by all means, Melbourne's going to be great for you for a long-term win, because the prices will double ultimately over the coming years. Not next two, but the coming years.
Yeah. Yeah. And the additional stock that's there in Melbourne at the moment does give rise to some of the better negotiating opportunities as well. So if you play the current window to your advantage and go in and negotiate strong, you could pick up some pretty good deals right now. But as Brendan said, don't expect a sudden 20% uplift in price in the next 6 to 12 months in Melbourne itself, because it's got that stock that needs to be whittled down a bit over time that has built up over the last 18, 24 months.
Don't expect those 100% returns like you saw in Perth over the last 3 years.
Well, they're coming, but they're not. It's
But
not
not right now.
not necessarily in 6 months' time.
And that's why we have the experts like yourselves on the podcast. Simon, Brendan, I think that's all we have time for today. Thank you so much for joining us on the SPI show.
Thanks, Liam.
Absolute
Appreciate
pleasure.
it. It's a pleasure to be here.
Now, make sure, I know what I'm doing right now. I'm going and downloading the app. Make sure you go online. Actually, before I say goodbye, what was the address to get the app again?
So to get into the real estate success community, you can go to realestatesuccess.community on the web and join up there for free, or you can simply search Real Estate Success on Google Play or the App Store and get the free mobile app as well.
Fantastic. Well, thank you both so much for your time. And that is all we have time for today on the SPI show. But until next week, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.